Hi, friends. Happy Friday. The weather is getting better. COVID cases are going down. We only have up from here. Nice. All right. So today I am going to review 3 stock investing myths and why they aren't true. My hope is to encourage all my smart friends out there who aren't investing to begin doing so. Myth number 1. Investing is scary. Why is this not true? Why is investing not scary? It's not scary if you do your homework and if you have knowledge of how the markets work, right? And you don't need to go to school for this. You have all this information at your fingertips. You can start reading headline business and market news. Just every day in the morning for 5 minutes, just review what is going on. All the buzz right now is interest rates are going up and stocks, especially high growth tech stocks, are going down, right? Just take 2 minutes to understand why that is the case. So do your homework, right? And investing really isn't scary if you're in it every day and you have a good understanding of why certain asset classes, so why the stock market has performed the way that it has in the past. So you can look at the past to understand trends, patterns, and behavior, how people react to news. And then once you understand that, you can formulate a view on where things will go in the short term and then in the long term. So really, investing isn't scary if you do your homework, if you're asking the right questions. And I would really recommend for all you beginners out there just to choose one stock, or Bitcoin is all the craze right now. You could just choose one asset that you think will run up this year and why you think it will outperform everything else that you have access to in the markets. So just track that one asset, and that's great homework because then you can understand the ins and outs of why it's trading the way that it is. And my second point here is that investing is not a spectator sport. A lot of people will say, "Oh, put together a paper portfolio," and so choose like a basket of stocks, for instance, that you think will perform well in whatever time horizon, and then track it. I don't think that actually really works because you don't have skin in the game. So I don't care if it's $5 or 500 or 5 grand, put to work whatever amount you're willing to lose to really learn, and take that first year or however long it takes for you to really get comfortable. Just take that time to learn. Myth number 2 is that investing requires a lot of capital. You can start with $1. For all my coffee drinkers out there, you can start with the cost of a cup of coffee. I paid $3 and some change for this. Starbucks. And just you can put that to work. You can buy fractional shares if you think Tesla is going to run up bigly this year, then you can buy, and you don't have $600-700 to buy a whole share right now. You can buy a tenth of a Tesla share, or you can I don't know, I purchased a few penny stocks in January that ran up 5 to 8 times. So you can put your $5 into one of those penny stocks. I mean, there are so many options out in the market if you look. Um, so investing, if you're starting out and you're here to learn, really doesn't require a lot of capital at all. If you want to see your money grow quickly, then you have to put down a lot of money, but I wouldn't recommend that for beginners because the chance of you losing all that money in one go is way higher. So I would recommend you to start off small anyways. So myth number 3 is that I can sit back and ignore long-term investments. And I think that this generally does work if you're looking at like a 10 plus year horizon. And if you're investing in really strong names out there, then yeah, sure, it works. But why would I not recommend this? Because as you saw with the stock market, cryptocurrencies this week, mostly in the red. So how can you benefit from actively managing your portfolio if you think that what you hold in your long-term portfolio is going to grow in the long term? Then what do you do when prices come down? You double down, you add to your position when prices go down, right? Because let's say you bought Bitcoin at $10,000, okay? But you have a view that it's going to go up, I don't know, to 500,000 this year, and you think that Bitcoin is the best trade right now. Why wouldn't you add more to your portfolio? Because you think it's going to run up a little more than 10 times at this point. So that's what I mean by actively managing. On the flip side, let's say that you're holding this position and you had a view that, oh, it's gonna double in a year, but it doubled in 3 months time and you weren't expecting that, and it's gone vertical in a really short period of time. Then what do? I would consider taking some profit, maybe a tenth of your position, a fifth of your position, but it's important to take your profit because that thing, again, stocks just don't go vertical forever. They're going to come back down at some point, right? So yeah, I would say that if you are going to invest yourself, and even if you have a long-term view on things, it's important to check in every now and then and to adjust as you go over time. So in conclusion, y'all, this is so funny. The fact that I made a PowerPoint presentation for you guys, ridiculous. Okay, but anyways, in conclusion, I would say do your homework, obtain a basic knowledge and understanding of why things trade the way that they do, and put a small sum of money to work. And this is not just for beginners. If you've been in this for a while and you're not making the returns that you would like to, then I would say stop putting money to work and take a step back. And then the last thing would be to be proactive in managing your funds. All right, until next time, peace.